Hi everyone, it's Ryan Perry, Simple Biz Support. Today we are continuing the conversation talking about tax planning. I have Evelyn Ivy with the Lifestyle CPA. She is the CEO and lead CPA for Lifestyle. And first of all, Evelyn, I want to thank you for coming back and joining me this Friday.
Thank you for having me.
Yeah, definitely. And I'm interested, we're going to talk about audit proofing your business. And what does that mean, first of all, before we go into the details of it?
Well, it means that you have to get your documents in order just in case of an audit. So before the IRS even sends your letter, or because you never know, it's random, well, somewhat random. So you need to have all the documents you need to have in place just in case. So if that happens, when all your documents are in place, then they're more likely like, okay, you're fine, let's move on to the next person. But when you're not ready, that's when they're like, okay, well, then get me this, then get me that, then it just becomes this big mess.
Okay, so I want to break this down a little bit just for those audience members that maybe are new to business or don't like to deal with the tax side of business. And so if we break it down just a little bit more, one of the things you said, these are documents that you should already have. So this is not a how to get your butt out of jail if the IRS comes. These are things that you should already have in place.
Exactly.
Okay. So this is like day-to-day operational type of stuff.
That's right. Mm-hmm.
Okay. And then the second thing that you said that caught my attention was, should you get audited? It's kind of like, I almost see it, it's like having your hand in the cookie jar, and mom catches you as a little kid. It's kind of like if you have a really good reason why your hand's in the cookie jar, they might let you off easier, or mom might let you off easier. However, if you're kind of going, I don't know, they may be more inquisitive at that point, want to dig a little deeper. And so is that what you were saying with the IRS? If you have your documents already
in place, prepared? Yeah, yes, they'll, well, you don't have to be doing anything wrong for them to audit you, because they're randomly people, so you don't have to have your hands in the cookie jar. You might just be a good everyday, keeping the law, doing everything, and you get the letter and say, hey, I need this. Okay. And that way you already have everything in place. Yeah, and that's good to know, because there is some randomness to it. There are some things that will trigger an audit per se, and my understanding is that can change from year to year. They may have something specific that they're really focusing on one year versus another year. Yes, that's correct.
Okay, so let's talk about, since we're talking about day-to-day business, these are records, these are systems that you should have in place. Is this like a top 3 list, a top 5 list of items or processes you should have in place?
I do have a list of processes. The first thing you need to do is make sure you have your receipts in place. You need to have a system of documenting your revenue. And you also need to have some accounting processes in place that you follow, because there's some things that in order to take some deduction, the IRS requires you to follow certain processes and have certain documentation in place. For example, if you're going to expense large items, you need to have a document in place. If you're going to reimburse yourself or reimburse your employees, you need to have a document in place. All of those things. If you're going to offer health benefits, there's a document in place for that too. All those things you need to have in place for, just to do your day-to-day, because people don't think about it. They just do what they do every day and don't think about, okay, let me create a trail for my actions.
Right, and so let's talk about a basic one such as receipts. Is it okay to just put receipts in an envelope these days? Do we have to put them in an Excel file or in QuickBooks?
Okay, you just have to scan it. Electronic receipts are acceptable. So if you, an electronic, like me, most of my purchases are online, so it's easy for me because I can just save the receipt in the folder. But like if you actually
file or something?
Yes. Okay. Excuse me, my throat. But if you actually go to the store and you go to Office Depot or anything, you can scan the receipt. There are a lot of apps that you can use to scan the receipt and throw the actual receipt away if you don't want a lot of paperwork. If not, you can just document that in your tax folder for the year and say, these are my receipts for ABC.
Okay, and I've heard that if you have a receipt for like $1, you don't need to save it. Is that true?
I mean, technically, they will let if it's just a dollar, But if you have a dollar 1,000 times, then that becomes, a problem.
Okay.
I
I
mean, you
wasn't sure if there was like the IRS is like, look, we're not going to worry about things that cost $20
yeah.
if you don't have a
Yeah,
receipt.
if
Okay.
it's a dollar, they'll probably like, okay, but like if you're doing it very often, I mean,
Okay.
at least
But
once,
technically, you should have a receipt for anything that you
Exactly.
purchase. You need to have proof if you
Mhm.
want to deduct that.
That's true. Yes.
And I'm just curious. So if you get audited and you are not able to prove, and let's just say it's $5,000, the IRS goes, look, you can't account for $5,000 in receipts. What happens at that point typically?
It depends on what you have, but every agent is different. Some are more lenient and some are very strict. Some might just be like, well, I'm not going to allow this, or can you provide some other proof? They might maybe ask you for, maybe can you go to your bank or go, they'll try to see if there's any other kind of documentation you can provide that shows that you actually bought that.
Mm-hmm.
Bank statements, normally they don't accept that because they want to see that, what it was for, sometimes, and it depends on, let me take that back. It depends on where you buy from. If you buy from a place like Walmart, like if your bank statement just says Walmart 5,000, generally they don't accept that because you can buy anything from Walmart for 5,000. But if it's like a specialized store, like obviously it has to be something for your business. It's really specialized. That's all they sell. Then that can be used as a proof. So it depends. Yeah.
Okay. So if you're a deli, as an example, and you're buying meat from Frank's Meats,
Mm-hmm.
they may be a little bit more lenient versus, Walmart. Did you buy a TV screen for the family, or did you actually buy office supplies?
Yeah, and the Frank's, that's iffy because you can use it for personalized, I'm going to make my grocery my dear kind of thing.
Yeah,
So
that's
it's
true.
more
I didn't
like
think about
it's more
that.
like if you're an
Right.
engineer, you buy chemicals. Obviously, you're not going to use those chemicals at home unless, but
Right.
it's mostly going to be for your business.
Right.
And
And
that's really
unless
obvious.
you're a high school chemist teacher on Breaking Bad, then who knows what's going to happen.
Exactly. Yeah.
All right. So number one, make sure you have documentation for purchases, and make sure you have a system in place for tracking it. Maybe paper receipts, and I still keep all my paper receipts. I just put them in an envelope with a credit card statement. That way it's all together.
That's cool.
The idea of like taking a picture of every single receipt or sticking it on the scanner, I'm like, stick it in an envelope. That's the way I do it. So, but
Yeah,
everybody's got their
fine.
own system.
It works. That works. So that's good.
Okay. So after we keep track of all our receipts, what should we be doing next as business owners?
You want to make sure you have a system of invoicing your customers. For me and you that we're online businesses, it's easy because obviously you have to send an invoice. But when you're a face-to-face store, it's not as obvious because sometimes you might go to a mom and pop store and buy something and you don't always get a receipt, right?
Right.
They might not write you one, or they might not ring it up, it's like, just go, but you have to make sure that you have a system you follow for every single customer invoice, whether it's cash payment or not. You have a system of collecting the receipts and documenting it. So, and you have to have a system in place that is in alliance with the IRS system. In other words, your income should not be counted as income when you deposit money in your account. You actually count as income when you collect it from the customer, not when you deposit in your account. So if the only time you count it as income is when you deposit into your account, well, they can still make adjustments to your income because there was some income you earned in 2017 that you didn't claim because it didn't come in through till 2018. So your system of documentation should be before it goes into the bank, and if it's cash, you have a system of documenting your cash, so that way you follow this. Because what happens if you don't have a system, the IRS will create their own system and tell you this is your income. So
last thing you want is the IRS, I would imagine, telling you how to run your business.
That's right, because they'll tell you make $200,000 when you only made so if you don't have a system, well, you can't prove it. So unless you can prove you didn't make this money, that's how much I'm going to say is your revenue.
Okay. And having a system in place, could that be as simple as opening up an Excel document, typing in the customer or whatever the work was, a total amount, and then emailing that Excel file to somebody?
That's correct. But it has to be something you consistently for every customer. So when there are exceptions, that's when you have problems.
Okay, and then with that, do you need to maintain that documentation on your end also? So if it is an Excel file, do you need to print it, save it as a PDF, or maintain that Excel file as a document?
Yeah, you can save it on your computer. I would recommend you have an accounting software like QuickBooks. You just create an invoice, send it to the customer, and it's there.
Right.
QuickBooks is keeping track of all that for you, and you follow that system. So even if you have a face-to-face customer, you still go back, you write the invoice. Even if they pay you cash, you go back and you write that invoice. That is your system in place. You have a system for saying, okay, when I meet a customer after we sign a contract, the next thing is send them an invoice, and you follow that consistently, then it makes your books more trustable.
Okay, and it sounds like the key word on this is having a system in place.
That's right.
Consistently.
Okay. Yes.
All right.
Yes.
So we're tracking invoices.
Yeah, go ahead.
I was going to say we're tracking invoices so we know what we're spending. We also have a system in place for invoicing customers so we know how much money we're actually receiving. And then what would the third item be?
So the other thing is large expenses. So like, let's say you go to Office Depot and you buy a computer. Do you expense it? Maybe the computer computers are getting less and less expensive. So do you expense it and put it as supplies, or do you capitalize it, which is you put it as an asset and depreciate that over time? You can expense it provided that you elect to. And to elect it, you have to have a written document in place saying, I elect to expense, these little expenses below, you can go up to $2,500. And you have to elect to do that on your tax return to every year. So if you're having purchases that will last more than 1 year, so for example, you go to Office Depot, you buy a pen, obviously the pen is just going to last for a short time. It's not going to last forever. So those are expenses. But if you go buy a computer, you're not going to buy a computer just for 1 year. You have to buy for multiple years.
Okay, so let's use this as a scenario because I'm a little confused here. Let's say I buy one of the best computers that they have and it's $5,000. So we've exceeded that $2,500 threshold that you've stated. At that point, am I required to amortize the cost?
Yeah,
you have to expense it?
No, you can't expense that. That's way too large.
Okay, and does it matter if you're a sole proprietor or if you're an S Corp or C Corp?
It doesn't matter.
Doesn't matter.
Now, if you're a very large corporation where you have like audited financial statements, you can go up to 5,000. But I don't work with clients like that. So I work with small businesses where 2,500 is their limits.
Okay, so if I go out and buy a computer, say it's $5,000. I just, because I have a system now. I'm invoicing my clients and I'm putting my receipts away. I can't just plug that into the computer and forget about it at $5,000. I need to do something different to amortize it then.
Exactly. You can't expense it. You have to write it as an asset and then depreciate over time. Now you can elect to do a Section 179, which is you can take the deduction in 1 year in your tax return, but that's still depreciation. And then you ask me, what's the point of doing this, making this election and doing a Section 179? The difference is how much you have to pay your accountant to get your taxes done. Because now they have to file the additional forms in order to do that Section 177, depreciate that item, versus if it's an expense, it's just a line item that just have to enter in your tax return.
Okay, and I'm assuming then it's kind of important for you as a, for you as a business owner to let your CPA know that you've made some major purchases.
That's right.
Can we kind of across the board say over $2,500, or does it vary by industry or how you're
any purchase you made, even if it's $1, any purchase you made that's going to last more than a year, you have to let your CPA know, and they'll tell you what the best course of action should be. So the point is, how long is it going to last? Are you going to use it all up in a year, or are you going to use it all, use it up as soon as you buy it?
Right. Okay. So the important thing is, am I going to use it in a year, being 365 days?
Exactly. Yes.
Okay. And then as far as being able to expense items, is 2,500 the cap then? You can expense anything under $2,500?
Yes. If you make the election then yes, that's the cap you can.
All right. And then were you saying that you actually have to have a form? So is there like a government form that says,
No, it's
I,
actually
Ryan
just
Perry?
no, it's just you getting the piece, because you should, every business should have an accounting process. So you should have like your accounting system in place where, okay, this is how we do revenue, where we recognize revenue, this is how we recognize expenses. This
Right.
is what this is our threshold for capitalizing assets. So in that document where you document all your accounting processes, you would document, okay, if anything is below 500 or 2,500, we're going to expense it. And if it's above 2,500, we're going to do the depreciation.
Okay. So that is for companies that actually are documenting their accounting practices. So as an example, I manage all my day-to-day accounting, and then I send my paperwork or a file nowadays, because I'm on QuickBooks, to my CPA. I don't necessarily have those documents. Is that from the IRS point of view, from this business audit that you're talking about, is that not a good thing then? To not have like a little manual that says, you know, this is Simple Biz Support's financial documentation process.
It helps you. It will help you. I mean, if you don't have it and you have, because it's the whole picture. So if your whole picture is looking good, like you have a system you follow and everything, for the most part, you'll be okay. So it does help you. But when you have those processes, it actually speeds things along faster, because you can say, this is exactly how I do it. Here's my process. This is, here's where I made my election. This is, so they see that, oh, there's a system to this. It's not just you just acting randomly.
Okay, interesting. Interesting. And is this something that CPAs, if you were to ask them, would they actually produce this document for you?
Not all CPAs do, but I do have a template I have on my website. So.
Okay. All right. That is good to know.
Yourself.
And then, so we're collecting receipts, we're invoicing people, we're making sure that we have systems in place to understand if we're going to expense or amortize our expenses. Number 4.
So distributions, you can't just go to your business and say, hey, take money as you want to. First of all, as an S Corp owner, you should pay yourself a salary. You should, you should be on payroll. Mm-hmm. And then your distributions is kind of a reward for, hey, I've done a good job this year and made like $100,000, so I'm going to take so much out of it. So distributions have to come from profits, and you have to declare it so you can't just take it. You have to be like, okay, have documentation in place saying this is how much I'm going to take out because based on this. And this is normally done as part of your annual meeting. And even if you're the sole owner of your sole proprietor of your business, you still have to have one, because when you win the Secretary of State and you sign that paperwork, kind of a contract you have with them, that you're going to have a meeting every year. And because if anything goes wrong and you're not following those processes, what's going to happen is they're going to say, okay, you're not a real corporation, or you just did that for, whatever reason, that they can, pierce the veil. So you have to follow this formality because it protects you. So the distributions, every time you take a distribution, you should probably document it in your annual meeting. You should document it in the agenda, and, and then take it systematically. So for example, you might say, okay, we're taking out every quarter, or you've been taking out once a year or twice a year, but not what I see a lot of entrepreneurs doing is they need $100 from the, they're like, oh, I haven't write a check to themselves. That right there is frowned upon by the IRS, because they could come back and say, you know what, that's not distribution. That is part of your payroll, especially if you're underpaying yourself.
Right. So let's clarify that then. So are you saying if you're having a good year, as an example, revenue is greater than you expected, are you saying when you have your annual meeting, that's when you can decide what that distribution will be for people that are an S Corp? Is that the proper ideal way of doing it?
It doesn't have to be higher than usual. You just need to have a profit, because distributions come from profit.
Okay.
So it could just be your normal payment, your normal profits. But the point is, it has to be declared at some point, and the best time, you don't have to do it then, but the best time to do it is during your annual meeting. And that way you say, for the following year, this is exactly what I'm going to take out, and this is when I'm going to take it out, and then take it out systematically.
And if I'm going to take out X number of dollars, does it actually need to be X number of dollars? So every quarter I'm going to pull $1,000 out, or is it a percentage? Can I just say I'm going to pull 25% of any profit that the company made in the quarter?
You can do either. You can say 25% of any profit made that quarter. You can say, I'm just going to pull $5,000 out,
Okay.
Based on last year's performance.
And then how does that affect taxes at that point? As an S corp, is there a form that needs to be filed to the government that says ex-employee got a distribution, or it would be a distribution of say $5,000?
I mean, you do report it on the tax return, but it's not exactly reported. So it's just a documentation for you, because they can come back and say, hey, I see you took $20,000 for distributions. Can I see where you declared that? Can I see where they might ask for that paperwork. And if you can't show it, especially if you're not paying yourself enough, maybe the market is like $50,000 and you're paying yourself like $10,000, taking $40,000 out on distributions, that could really come to contest that. Say they want to see your process, like why is this so? Why are you, what it will mostly happen when you're taking out less money in payroll and taking a lot of distribution out. Right. So that's when they'll come after you and say, okay, why are you doing this?
Okay, because you're not actually paying taxes on the distribution, are you?
That's right. You're not paying taxes, payroll taxes on distributions.
Right. Okay. So that is, I would assume from a tax planning point of view, that's something to consider, being an S corp if you're on the board.
That's right.
Okay.
Yeah, you want to consider the fact that how much should be compensation, and you should document how you determine your compensation too. So that's another documentation you need to have. Yeah. And
this is not like a formal form that you get from the IRS. This is just kind of an internal document.
Exactly. These are internal documentations
for XYZ corporation.
That's right.
Okay. All right. Good to know. Good to know. I'm learning a lot here, so I appreciate that. And I'm hoping that the viewers watching also are learning, but they're also know that they can ask questions down below, because we will follow up and answer questions as they pop up. Is there a number 5? I mean, we're talking about taxes. Yeah. I'm assuming number 5.
Yeah, loan. If you're going to take a loan from your business, you have to make it formal. You have to take interest out, and you have to have a loan agreement. That has to be documented. Just like you have to internally document the distributions, you have to internally document the loan. So draw up a loan and say, X, Y, I take, either you've given the business a loan, or either you've given the business a loan, or the business is giving you a loan. So you have to document, either way, and there has to be an established interest rate and market interest rate, and the payment has to be made systematically. So if you're taking a loan, they want to see, and the monthly payment was $500, that $500 has to be paid systematically every month. If not, it's considered not a loan.
And if it's not considered a loan, what might happen then?
So if they might just say you're just taking out distributions from your business. If you don't have enough basis, then it's taxable.
Okay. All right. That's good to know. And then
also might say it's dependent. I even say it's payroll too, and then charge your payroll taxes.
Right. And then you got to, pay payroll taxes on that. And back interest and all that type of fun stuff, I would imagine also.
That's right.
Yeah. And then what if it's the other way around? What if I'm going to loan money to the company?
You also need to document it.
Okay.
So when the company is paying you back, you can say, this is money payment for the loan.
Right. Okay. And then number 6?
And then if you're going to contribute money to your business, so, you can put money in your business as a loan or contribution. So when you contribute money to the business, make sure you document that, because that becomes part of your basis, which means when you take money out, anything above your basis is not taxable. So you want to have a list of time you put money into the business. When you contribute, you don't have to have a loan agreement like in the contribution, but you just need to document that. And that should probably be part of your shareholders meeting too.
Okay. And is there typically a reason why somebody would contribute money to the business? I mean, generally we're in business.
Yeah, if they have a very cash intensive business or capital intensive business, they'll have to put money in there just to keep the business running.
Okay. All right. And is that considered a loan then at that point?
That's what you have. That's why you have to document saying this is a contribution, not a loan. So
okay. So there's no obligation for the business to repay it at that point.
That's right. That's
okay. Right. And does that benefit from the personal side? Do we get to deduct that, or is there any benefit?
No, you don't. You don't deduct. But what happens so it's kind of like when you buy an asset, like you buy a house, right? If you sell it, you get taxed on the gain. It's the same thing. The contribution adds to your basis. So when you sell your business, you don't have as much gain.
Ah, okay. So that's kind of a long-term play then.
Yes. Mm-hmm.
Okay. All right. Number 7.
Mileage log.
Oh, yes.
Oh,
Let's
did I
talk
get
about the
you?
mileage log. That is like the most exciting thing to do, I think, for any business owner. I have one question for you around this because I think everybody understands the mileage thing. And that is, I got a buddy who's a real estate agent, and he says that he only, and again, he's in real estate, so it's common knowledge that he's probably going to have to drive quite a bit. But he says he only has to track for the first quarter, and then they just average it out for the rest of the year. Is that possible? Is that true? Or is that a little
it depends
grayer?
on who you get as an agent. Some agents will let it fly, some will not.
Okay.
Now, I will, just because you never know who you're working with, because some people are really, really nice and some people are not so nice.
Mm-hmm.
And you just never know who you're going to get. And yeah, I mean, I've heard that. I've heard people do that too, but I wouldn't advise that. I would just say, go ahead and you know what, you can get an app. And what happens? Have you heard of those apps too?
I've tried one, and then they wanted like $5 a month or something. I'm like,
oh, okay.
I have my little notepad. Fortunately, I don't do a lot of driving these days.
Yeah.
So I have my little notepad in the car.
So for him, it will make more sense because he probably drives a lot more. So if you were driving, driving a lot, $5 a month to track that, so you don't have to worry about it. That's a piece of change.
Right. But, yeah, because it's the amount of time and effort it's going to save you, and then you just got to remember to turn the app on and this is personal. That
exactly. Yes.
It's not that I have an issue tracking it. It's just that, my goodness, every single time you get in the car, and
you know what else
like
they'll accept? You know what else they'll accept? An agenda, like a schedule. So if you keep a schedule of where you're going and where you're coming from,
okay.
You keep the standard miles. But for example, go on MapQuest, say from point A to point B is 5 miles, and you can show your calendar to them and the mileage from point A to point B and what you were doing. They accept that too. So if you don't want to keep the miles, just keep a calendar. Okay.
But you would still need to then go back if you're not tracking it on a daily, monthly, weekly basis, whatever that is. If you are audited, even if you have the calendar, you're going to have to go back through each day and figure out what that mileage is and put it in a spreadsheet or something.
Yeah, and if you're on Google, if you have a Google calendar, it's pretty easy.
Right. Yeah. Okay. Very good. So yes, please do track your mileage, people. I know you're already doing it, but in case you're not, feel free. The IRS will very much appreciate it, I'm sure.
Yes, definitely.
All right. What's after mileage?
Independent contractors versus employees. So,
ooh, that can be a hot topic for some people.
Yes, because people want to save money, and the topic of independent contractors versus employees goes way beyond the IRS, because the state is also very interested in this topic, because they have a large interest in this too. You have unemployment department, you have the Department of Labor, you have the Department or your State Department of Revenue, you have the IRS, you got the you also have I heard this case. There was this case of where the United States Immigration fined somebody because they didn't have an I-9, and they got in trouble with the Immigration Department. They got in trouble with the IRS. IRS started. The immigration came in. The states came in. It was just a big mess, So that is huge, because you get in trouble with so many departments that it's crazy. So when you misclassify an employee, it's not just the IRS that comes in. Right. There's so many other departments you're dealing with. So the thing is, you want to document the relationship you have with this employee. So if you have control over this, I don't say employee, this person's time. So you say, come here between 9 and 2, do A, B, C, D, exactly 1, 2, 3. They cannot be your independent contractor. They are your employee. And if they're your employee, then you have to have a W-4, I-9. They have to, Social Security card, copy of the Social Security card, copy of their driver's license. You have to have all of those on file for your protection, because if you don't have that on file, immigration is going to come in and they can find you too, not just the IRS, you know?
Yeah.
So,
and then you got to have the posters on the wall somewhere and all the other stuff. I've heard
so
of
that's
people
workers'
being fined.
compensation. Yeah, we'll come back to
Okay.
later. That's something different.
But wait, there's more.
But, yeah. So but if they're contracted if they're serving other employees, other people, like they have other customers, obviously they're not your employee. You just want client to serve. And if they're independent, like a sole proprietor, you want them to fill out a W-9 and you want to have that on file.
Okay.
So every contractor you deal with, so if they're B corporation, they don't have to have a W-9 on file. I do recommend you get the W-9 first before you pay them, because once you pay them, what I found is people disappear and you can't find them anymore. And then you can't give them a W, or if they're like really small time, they get very angry when you give them 1099, because first of all, you have to have the W-9 in place to file the 1099, but you can't file the 1099 unless you have the information on file.
Okay.
The W-9 is the form that you get all their personals, like their name, business name, social security number, EIN, and then the 1099 is what you send them at the end of the year for what you pay them. So so at the end of the year when you have to file your 1099, they won't give you that information because they don't want to file their taxes, you know, and they get very mad.
Right.
It's like, well, you know, I've seen like fights happen just because of this topic right here. Because I thought I was working on the table.
Yeah,
But,
and I think, well, yeah, we won't go into details, but it is, and there's a lot of, you have to understand what qualifies, and there's a lot of qualifications. There's been, I know Amazon's gotten in trouble. Microsoft was a huge case years ago. So we'll leave that alone. That's somebody, if you're in that question place, talk to somebody who knows, because I kind of get the sense that it's still a little bit of a gray area on the IRS's side. They can lean one way or the other depending on what they want to do.
But then if you have the documentation in place, that protects you. So for example, if you're working with a contractor, you have a contract in place, for example, and then you show the terms of the contract, and then you have the W-9 in place, you know, that they're more likely to leave you alone than if you have nothing.
Okay, that's good to know.
And then at the end of the year, you issue the 1099. But if you have nothing, then that's when you get in more trouble. And if they're your employee, if you control their time, just make sure that you pay them as an employee.
Okay, perfect. All right. We're going to cut there because I show we're at 44 minutes.
Okay.
How many more items do you have?
I mean, we've covered the major ones. That's pretty much the major, yeah.
Okay. This is, I'm assuming, I haven't gone this long before. I'm assuming at 45 minutes, it's just going to disconnect us. I have no idea what's going to happen. What I'd like to do is I'll just send you a second request because I can have multiple meetings. They just can't go past 45 minutes, and then I'll just plug them together. So I am going to send you an email with another request.
I think we're pretty much done. Well, the only last thing I want to talk about is the annual meeting.
Yeah, I want to have that, and then I want to close it out also, let people know where they can reach you and thank you and all that type of fun stuff. So I'm just curious because I've got 5 seconds here, so I'm just curious to see what happens. 9, 0.
Happy New
Year! Well, tell you what, it's still going. So let's just keep on rolling and see what happens. I think we're on number 8, are we not?
I'm not keeping
on number 9. I'm not sure. But I know there's one more. So what is the one other thing that you should do in order to audit your business?
Annual meeting. That is so important because that's something the IRS requests when they're auditing. You know, they want to see that you actually have this, and because that's where you document a lot of your important decisions, like how much to compensate the owner, what distribution should be, and the annual meetings should be documented. There's a process. You should have the agenda, you should have the minutes, all of that should be documented. So with the annual meeting, what I recommend is, obviously if you're the only one that owns the business, it's just you probably don't want to sit down on your table talking to yourself. So you can invite your accountant or get a consultant or somebody who will advise you in your business, and use the annual meeting as a time to actually review what happened in your business and develop strategies for the next year. So use that so you can combine that. And that way you can meet your documentation requirement, and actually set time aside for reviewing your business and planning for your future growth.
Okay, and is this something that CPAs will do? Because in the past, I've always done it with an attorney. And that was a different business that, you know, we were doing millions of dollars. You had multiple board members and all that type of stuff. We always had an attorney that led the meeting. But you're saying doing it, if you're a smaller business, do it with your CPA. Is that a service that some CPAs will offer then?
Well, I do. I don't know if others do,
Okay.
but yeah.
All right, because you don't necessarily need an attorney, but there are, I know I've seen the forms online that I filled out, because I talk to myself, unfortunately, when I do mine nowadays. But I never thought about sitting down, because you should be sitting down with your CPA every year, this time of the year, by the way, which is what we're middle of October now, and having those discussions about tax planning for your current year, and then what are you going to do for the following year?
That's right. And it's mostly not just tax, just growth, like things like, okay, how's your business doing? Your profit margin, looking at your margins, looking at opportunities, looking at things like that. And they can see things that you can't see because they understand the numbers better than you do.
Right. And they're outside of your business, so they don't have the blinders on that a lot of business owners do, I think.
That's right.
Okay. And then as far as audit in relationship to having the annual meeting documentation, how does that kind of fall into audit proofing? If you are audited by the IRS, they go, okay, we want to see your annual meeting notes, and you don't have them. What might happen at that point?
Well, they'll mostly ask it for proof or stuff like distributions or things like that. So they can reclassify transactions based on you not being able to provide proof.
Okay, which could lead to less
taxes.
deductions, more taxes, so on and so forth.
Yes.
All right, perfect. All right, and for those that are interested in learning more about this CPA, the services that you offer, where can they and should they go?
They should go to lifestylecpa.com. And if you want a template, then go to bizexceltemplates.com.
Okay, perfect. And I will put those links down below so you'll be able to see them and access that without problem. You can just click the link below. Evelyn, always appreciate you having you on and sharing the valuable information that you provide business owners.
Thank you.
Thank you. All right, everybody, that is it for today. Again, if you have questions, leave a comment below. If you found this video helpful, make sure to hit the like button. Let us know. Until next time, hope you have a great day. Take care.